Our next guest says even if there is a trade deal, this tech Cold War between the U.S. and China is just getting started. Let's bring in Rebecca Patterson, Chief Investment Officer at Bessemer Trust. Rebecca, always great to see you. You're overweight technology, though. So how does that square with this notion of a tech Cold War?
Well, a lot of the conversation you all have been having on the desk already with some of the organic growth that we think we're going to continue to see, whether it's in a Tencent or Alibaba in China or something like a Salesforce here in the U.S. We don't think that's going away, whether there's a trade war or not. There's going to be a lot of noise and volatility in the single names, but as a trend, we still like that trend. But the whole concept of the tech Cold War, which we started writing about a year ago, is the idea that just like we saw when the U.S. got nervous about Japan in the 1980s, the U.S. is now having similar, not exactly the same nerves about China today, that China, as it goes on its growth path, could become the largest economy in the world on a number of different fronts in our lifetimes, in our career. But it's not just the economic strength that makes us nervous. It's about what they do with the technology that could translate into geostrategic strength and military strength. And so 5G is just an example. Huawei is an example of the tech dominance that I think makes the U.S. fearful. And it's not just a Republican Party issue. I think there's bipartisan nervousness around this. And that's why I don't think the tech Cold War goes away. I think there is a good chance we'll get a trade deal. I don't know when it is and what the details of the deal are. But even if we get that deal and some tariff levels go down over time, this nervousness and the limitations our government's going to try to put around tech to protect the U.S. economically and militarily is here for a long time.
So how do you extrapolate the 5G build out to other subsectors within technology?
So you have to think about if the U.S. is going to make it harder for us to partner overseas with certain economies and vice versa. So where does the capital go? We're going to see companies relocating. We're going to see companies changing their supply chains over time. I'm talking about years, not months or weeks. So this is slow. It's going to affect capital flows. You have to think, who's going to be our ally? Who will America partner with? So do we see more money going to Scandinavian countries that are making telecom equipment? Do we have certain allied countries in Asia we prefer to partner with? So you have to think long term, where does the capital flow? Where do the trade flows go? You're going to have winners and losers from that. This is not even a long-term play. This is an ultra long-term play. But I think this is something everyone should be starting to get in their heads when they're thinking about making investments for the medium or long term. In terms of sectors, technology certainly, but it's going to feed through. I mean, healthcare right now, all the biotech, that's going to be hit by this. You're going to see a number of different sectors impacted, I think, over time.
So do you think it's just been a false narrative when you talk about a trade deal that, you know, the forced technology transfer and the IP theft has really been at the heart of this? And when we think about it, 2-year-long trade, but on a near-term basis, it seems like we're just focused on this trade deficit. And if we do have a deal about the trade deficit, that tariffs are going to become more prevalent as a compliance sort of mechanism going forward. And we might have just greater volatility with trade with countries like China going forward.
That's a really good point. I think the investors have kind of confounded these two issues, right? The tech Cold War and trade, they're parallel paths. These are different issues that just overlap to a degree. So when the trade deal included that China had to change its laws on tech, that's where these two things collided and where the Chinese, I think, said, you can't tell us to change our laws. That's our country's right. But I think to your point, you know, the government is realizing that tariffs can be an effective political tool. There's bipartisan support in a lot of fronts for going hard on China, not necessarily the trade war, but going hard on China. So I think tariffs are a tool that may be with us for a while. And the longer it lasts, back to your point earlier, Tim, on Europe. So the longer the tariffs are in place, the harder and longer the hit to the manufacturing sector globally. So you look at the manufacturing sector PMIs, you look at places like Germany that are exposed to this. The longer this goes on, it's a cumulative effect. Those countries can't bounce back.
So many companies across sectors were looking to China and that area of the world for growth. And if you eliminate that or severely cut that expectation back, should multiples be capped then in the long run?
I mean, people are still going to want to do business in China.
Sure.
I mean, even if growth slows in China, it's a big pie that's still growing. And you've got this amazing consumer base that's getting more and more mature and sophisticated about what they want to buy. So I think you're still going to see capital there. You're still seeing businesses that want to go there. But if you have that incremental dollar, that marginal dollar, do I want to invest it in China or Vietnam? Or do I want to invest it in China or maybe a Scandinavian country if I'm telecom? Now you have a conversation. Before it wasn't a conversation, it was a done deal. So now I think you're going to see more diversion in companies as they're making those longer term decisions, especially if they think this is going on for the foreseeable future.
Rebecca, thank you. Rebecca Patterson, Bessemer Trust. We appreciate it. Your incremental dollar, where does it go these days since you're looking at the world?
Well, she brought up a Tencent and an Alibaba and some of these names. I mean, I don't think that these are trade war stocks in the way they are treated. And in fact, I think, we talked about, and I think Mark even talked about places where you're going to see some extreme opportunities to be buying. I mean, look, I think Apple at $180 is getting to be extreme. I think certainly if you look at the move from 195 down to 160 on Alibaba, almost like that, in fact, that we probably closed through that. So I think you have an idea where I think companies that are true tech players that are not necessarily reliant on global capital flows are going to be at risk. I think you have to really be careful about data as the new oil, and this is this whole Cold War concept that she's talking about. Think about where we were 10 years ago and how protectionist we were over resources. Every country in the world is going to be doing this right now on tech.
I think quickly, I think the microscope is going to be off healthcare. Healthcare actually hangs in there pretty well. You look at UNH, by the way, quickly up 11.5% over the last couple of weeks, and I think that continues to go higher. But Tim mentioned EEM, as did Rebecca. I'll say this, in terms of the ETF EEM, 38.5. Better hold. That was the low back in October. Recent low again. Breaks 38.5, and things get very dicey very quickly.
So I think there's some huge opportunities. You mentioned healthcare. So I think there's some huge opportunities within medical devices, medical equipment. A few names we like: Intuitive Surgical. I think there's great opportunity there. You're seeing more and more surgeries nowadays being done by or with robots, and they're really one of the leaders in that industry. Another one we like is Abbott Labs. They're doing great stuff with diabetes management, so I think there's good opportunities there.
Yeah, I just mentioned that, Apple, obviously China's been huge for them, but it's also been a huge source of volatility. And then when you think about global growth for some of our tech behemoths, they've been unable to get to China, and they may never be now. That's Facebook, that's Amazon, that's Google, and it's Uber. So the list goes on and on and on, and you have to see, how do you price incremental global growth if China's not going to be a part of it?